At 9:47 a.m. Eastern Time, silver was declining rapidly on the paper exchange. At 9:51 a.m., one of the largest online precious metals dealers in the United States went offline. The website returned a maintenance page. Orders could not be placed. Prices could not be viewed. Inventory could not be browsed. At 10:03 a.m., a second major dealer's website became unresponsive. Timeout errors replaced product listings. At 10:14 a.m., the London Bullion Market Association's daily price-setting mechanism experienced what was described as a technical interruption. The benchmark that serves as the global reference for physical silver transactions was temporarily unavailable. Within 30 minutes of a significant paper price decline, the infrastructure through which physical metal is priced and purchased went dark. This is not analysis of what caused the outages. Technical failures occur, servers crash under traffic surges, systems experience legitimate malfunctions. This is analysis of what outages during price declines mean, regardless of cause. Because the pattern itself carries information. The pattern is the data. And the pattern, observed repeatedly across years and across markets, reveals something about the relationship between paper prices and physical access that warrants careful examination. There is an assumption embedded in modern commodity markets that is so fundamental it is rarely stated. The assumption is that the price on the screen and the price of the physical object are the same thing. When a screen displays silver at $90, the assumption is that silver, actual, physical, hold-in-your-hand silver, can be acquired for $90 plus a reasonable premium for fabrication and delivery. This assumption is the foundation of the entire pricing system. Futures exchanges, dealer networks, industrial procurement, central bank reserves, all reference the screen price as though it represents physical reality. When this assumption holds, the system functions. Buyers and sellers transact with confidence that the screen reflects truth. Arbitrage ensures that any divergence between paper and physical is quickly eliminated. When this assumption breaks, the system fractures. And the assumption breaks most visibly at the precise moment when participants most need it to hold, during sharp price declines, when buyers wish to acquire physical metal at the newly lower price. The mechanics of a paper price decline are well understood. Futures contracts are traded on exchanges. Participants buy and sell contracts representing the obligation to deliver or accept metal at future dates. The vast majority of these contracts are settled in cash. No metal changes hands. The price of these contracts is determined by supply and demand for contracts, not by supply and demand for physical metal. When a large volume of sell orders hits the futures market, the price declines. This is mechanical. Selling pressure exceeds buying pressure. The price adjusts downward until equilibrium is restored. The selling may be driven by various factors: profit-taking, margin liquidation, speculative positioning, algorithmic trading, or deliberate attempts to move the price. Regardless of the cause, the result is the same. The number on the screen goes down. But the number on the screen is a futures price. It reflects the price of a promise to deliver metal at a future date. It does not directly reflect the price at which physical metal can be acquired today. In normal conditions, the two prices move together. Arbitrage ensures convergence. If the futures price drops below the physical price, arbitrageurs buy futures and sell physical. If the futures price rises above the physical price, arbitrageurs sell futures and buy physical. This arbitrage mechanism keeps the prices aligned in normal conditions. But there are conditions under which arbitrage breaks down. When physical metal is scarce, selling physical to buy futures is not possible. You cannot sell what you do not have. When dealer inventories are constrained, the physical price cannot decline to match the futures price because dealers cannot source replacement inventory at the lower price. When the infrastructure for physical transactions goes offline, arbitrage cannot occur at all. In these conditions, the paper price and the physical price diverge. The screen says one number, the real world says another. The history of dealer outages during price declines is longer than most participants realize. In March 2020, during the pandemic market disruption, silver futures crashed below $12. Within hours, major online dealers suspended sales. Those that remained open quoted prices of $18 to $22 for physical silver, premiums of 50 to 80% above the futures price. The screen said $12. The physical price was $20. The gap was enormous. Participants who attempted to buy physical silver at $12 discovered that $12 silver did not exist. The price on the screen was available only to those willing to accept a futures contract, a paper promise, rather than actual metal. The outages were attributed to unprecedented traffic. Millions of people attempting to buy silver simultaneously overwhelmed the servers. This explanation is plausible and likely contains truth. But the explanation does not address the fundamental question: why were premiums so elevated at the dealers that remained online? If the $12 price were real, if physical silver were genuinely available at $12, dealers would not need to charge $20. They would source at $12, apply their standard margin, and sell at $14 or $15. The premiums revealed that dealers could not source physical silver at the futures price. The futures price was a fiction, a number on a screen disconnected from the cost of acquiring actual metal. The outages, whatever their technical cause, occurred at the precise moment when this disconnection was most visible and most actionable. In January 2021, during the coordinated retail buying event that drove silver futures higher, the reverse occurred. Futures spiked. Dealers went offline or restricted purchases. The infrastructure could not accommodate the demand. In September 2022, when silver futures dropped sharply, multiple dealers experienced outages. Again, those that remained online showed elevated premiums. The pattern repeats. Sharp paper price movements are accompanied by infrastructure disruptions that prevent or impede physical transactions at the paper price. There are multiple explanations for this pattern. Each contains partial truth. The first explanation is purely technical. Sharp price movements generate extraordinary traffic to dealer websites. Traffic surges overwhelm server capacity. The websites crash. This explanation is credible. Dealer websites are built for normal traffic volumes. A sharp price decline attracts bargain hunters. A sharp price increase attracts momentum buyers. Either direction generates traffic spikes that exceed infrastructure capacity. But this explanation has a weakness. Technology scales. It has been scaling for decades. Server capacity can be increased. Cloud infrastructure can handle traffic spikes. The technology to maintain website availability during demand surges is well understood and widely deployed. Major e-commerce platforms, Amazon, eBay, retail giants, handle traffic surges during events like Black Friday without going offline. The technology exists. The investment required is meaningful but not prohibitive. If dealer outages during price movements were purely a technology problem, the problem would have been solved years ago. The fact that it persists suggests either insufficient investment in infrastructure or that the outages serve a function beyond inconvenience. The second explanation is economic. During sharp price declines, dealers face a pricing dilemma. Dealers hold inventory purchased at previous prices. If the paper price drops 10% in an hour, the dealer's inventory is now worth less than what was paid for it. Selling at the new lower price means realizing a loss. Going offline, even briefly, provides time to reassess, to evaluate whether the decline is temporary or sustained, to adjust pricing, to hedge exposure. This explanation is also credible. Dealers are businesses. Businesses manage risk. Temporarily suspending transactions during volatile conditions is a rational risk management response, but this explanation has an implication that is rarely stated. If dealers go offline during declines because they cannot profitably sell at the paper price, then the paper price does not represent the true cost of physical metal. The paper price is below the economic reality of physical acquisition. The offline status is itself a price signal. It communicates that physical metal at the screen price is not available. The real price is higher than the screen shows. The third explanation is structural. The paper market and the physical market are different markets. They reference each other, they influence each other. In normal conditions, they move together. But they are not the same market. They have different participants, different mechanisms, different constraints. The paper market can move instantly. 1 million ounces of paper silver can be sold in seconds. The price adjusts immediately. The physical market moves slowly. Metal must be sourced, fabricated, shipped, insured, stored. These processes take time. They have costs that are relatively fixed regardless of the paper price. When the paper market moves faster than the physical market can adjust, a gap opens. The paper price has declined, but the physical cost has not, because the physical cost is driven by factors that do not change in seconds. The dealer outages occur at the moment when this gap is widest, when the paper price has moved, but the physical market has not yet adjusted. The outages prevent transactions that would occur at prices that do not reflect physical reality. The London Bullion Market Association's role in this dynamic deserves specific attention. The LBMA administers the daily silver price benchmark, the reference price used by industrial users, refiners, miners, and central banks for physical silver transactions worldwide. The benchmark is set through a process involving participating banks and trading firms. They submit buy and sell orders. The process iterates until buy and sell volumes balance. The resulting price becomes the daily benchmark. This benchmark is supposed to reflect physical market conditions. It is supposed to represent the price at which actual silver changes hands in the London market. When this benchmark mechanism experiences technical interruptions during volatile periods, the implications extend beyond inconvenience. Industrial users who purchase silver based on the LBMA benchmark cannot price their transactions. Miners who sell based on the benchmark cannot execute sales. The entire infrastructure of physical silver commerce that references this benchmark is suspended. The interruption, whatever its cause, creates a vacuum. During the vacuum, the only visible price is the futures exchange price, the paper price that may or may not reflect physical conditions. Participants who observe only the futures price during an LBMA interruption may conclude that physical silver is available at the futures price. They may make decisions based on this assumption. If the assumption is incorrect, if the physical price differs from the futures price, decisions made during the vacuum are made on false information. The interruption does not create the divergence. The divergence exists independently, but the interruption conceals the divergence by removing the benchmark that would reveal it. The broader question is whether the pricing infrastructure for precious metals is adequate for the function it serves. The pricing infrastructure was built during an era when physical transactions dominated. Buyers and sellers met. Metal changed hands. Prices reflected the intersection of physical supply and physical demand. Over decades, the infrastructure evolved. Futures markets were created to allow hedging and speculation. Electronic trading platforms replaced physical trading floors. Speed increased. Volume increased. The infrastructure became increasingly paper-based. But the underlying commodity remained physical. Silver is heavy. It occupies space. It must be transported. It must be stored. It must be authenticated. The paper infrastructure operates at the speed of electrons. The physical infrastructure operates at the speed of trucks and ships and vault doors. This speed mismatch is manageable under normal conditions. The paper market moves. The physical market adjusts. The gap remains small and is quickly closed by arbitrage. Under stress conditions, the speed mismatch becomes unmanageable. The paper market can reprice in seconds. The physical market cannot. Dealer outages are one manifestation of this mismatch. The physical infrastructure cannot adjust as quickly as the paper infrastructure moves. Going offline is the physical infrastructure's way of refusing to transact at prices that do not reflect its reality. The LBMA benchmark interruptions are another manifestation. The benchmark process requires time to collect orders, time to iterate toward equilibrium. When the paper market is moving rapidly, the benchmark process cannot keep pace. These are not failures of specific institutions. They are symptoms of a structural mismatch between a paper pricing system that operates at electronic speed and a physical market that operates at material speed. The implications of this mismatch extend beyond individual transactions. If the paper price can move independently of the physical price, if the two can diverge during stress, then the paper price is not a reliable indicator of physical value during the moments when reliability matters most. This unreliability is tolerable when it is temporary and the divergence is small, but the pattern suggests that the divergence is not always small. In March 2020, the divergence exceeded 50%. Physical silver traded at more than 1.5 times the futures price. A 50% divergence between the price on the screen and the price of the physical object is not a minor discrepancy. It is a fundamental breakdown of the pricing mechanism. If the pricing mechanism can break down during stress, then participants must consider the possibility that the paper price is not the real price, even when the divergence is not visible. The divergence is not always visible because the infrastructure for revealing it, the dealer websites, the benchmark mechanisms, goes offline during the moments when divergence is greatest. This creates a paradox. The divergence is greatest when it is least observable. The observation infrastructure fails at the moment when observation is most needed. This paradox is not theoretical. It has manifested repeatedly. It manifested in 2020. It manifested in 2021. It manifested in 2022. It has manifested again. There are beliefs about precious metals pricing that this pattern challenges. The first belief is that the futures price is the real price. The futures price is a real price for futures contracts. It is the price at which paper promises trade. It is determined by supply and demand for those promises. But the futures price may not be the real price for physical metal. The two are related but not identical, and during stress they can diverge significantly. The belief that the futures price is the real price is convenient. It provides a single, easily referenced number. It simplifies analysis. It allows comparison across time. But convenience is not the same as accuracy, and the dealer outages during price declines reveal the limits of that convenience. The second belief is that arbitrage ensures convergence. Arbitrage does ensure convergence when it can operate, but arbitrage requires two-sided access. It requires the ability to buy in one market and sell in another. When dealer websites go offline, the buy side of physical arbitrage is disrupted. When LBMA benchmarks are interrupted, the reference for physical transactions is unavailable. Arbitrage cannot operate when the infrastructure it requires is offline. The convergence that arbitrage normally ensures is suspended during the moments when divergence appears. And by the time the infrastructure comes back online, participants have made decisions based on the paper price alone. The third belief is that outages are purely coincidental. Coincidences occur once. When the same pattern repeats across years, across events, across market conditions, the pattern becomes data. The data shows that dealer outages and benchmark interruptions clustered during sharp price movements. This clustering may have purely innocent explanations, but the clustering itself is information, regardless of explanation. What does this pattern mean for those who hold physical precious metals? It means that during the moments of sharpest decline, the moments when headlines scream crash and panic pervades, the price on the screen may not represent the price of the metal in their possession. The screen may say $90. The physical market when it reopens, when the dealers come back online, when the benchmarks resume, may say something different. This divergence has historically favored physical holders. The physical price has been higher than the paper price during stress events, not lower. This is not guaranteed to continue. Past patterns do not bind the future, but the pattern has been consistent enough across enough events to constitute meaningful information. The information is that physical metal and paper claims on metal are not the same thing. They are priced similarly most of the time, but during stress, they are priced differently, and it is during stress that the distinction matters. What does this pattern mean for those observing the monetary system? It means that the pricing infrastructure for one of humanity's oldest monetary metals is fragile. It means that the mechanism through which silver is priced, the futures exchange, the benchmark processes, the dealer networks, can fail during the moments when accurate pricing is most important. It means that the assumption underlying the entire system, that the screen price equals the physical price, is conditional. The condition is that the system is not under stress. When the system is under stress, the condition fails and the assumption breaks. This fragility is not unique to precious metals. It exists in many markets. Bond markets experienced it during the Treasury sell-off in 2020. Equity markets experienced it during the flash crash of 2010. Currency markets experienced it during the Swiss franc de peg of 2015. But in those markets, the underlying assets are paper. A bond is a promise. A stock is a claim on earnings. A currency is a unit of account. When the pricing mechanism for paper assets breaks down, the disruption is contained within the paper system. When the pricing mechanism for physical assets breaks down, the disruption reveals something deeper. The gap between the paper system's version of reality and physical reality itself. This gap is the information. The gap says that the paper system's version of silver's value and the physical world's version of silver's value are not always the same. And when they differ, it is the paper version that must ultimately adjust to match reality, not the other way around. Reality is heavy. Reality occupies space. Reality must be mined, refined, transported, stored. Paper is light. Paper is fast. Paper can be created and destroyed instantaneously. When the two disagree, which one is real? Gold does not rise. Confidence falls. Silver does not crash. Screens crash. The distinction between the price and the metal is invisible most of the time. The infrastructure maintains the illusion that they are identical. The screens update in real time. The dealers display inventory. The benchmarks set daily references. But the illusion fractures under pressure. The screens go dark. The dealers go offline. The benchmarks are interrupted. And in that darkness, in that silence, the question emerges that the infrastructure was designed to suppress. What is the price of silver? Is it the number on the screen, the number derived from paper contracts, from electronic trades, from algorithms and leverage and positions that settle in cash? Or is it the number at which a human being can hand over currency and receive metal in return? Actual, physical, weigh it in your hand metal. When both numbers are visible, they appear identical, and the question seems unnecessary. When one number goes dark, when the infrastructure that reveals the physical price goes offline, only the paper number remains visible. And the paper number, unopposed, undisputed, presents itself as the only truth. But the absence of the physical number does not mean the physical number does not exist. It means the physical number is not being displayed. The dealer website will come back online. When it does, the prices listed will reflect the physical reality that persisted during the outage. That reality may differ from the paper reality that was the only visible reality during the darkness. The LBMA benchmark will resume. When it does, the physical market will have continued to operate. Through phone calls, through direct relationships, through the ancient mechanisms of metal commerce that predate electronic infrastructure by millennia. The pattern is old. The pattern is persistent. The pattern carries information. The information is not about what to buy or sell. The information is about what is real. Paper prices are real as expressions of paper market conditions. Physical prices are real as expressions of physical market conditions. When infrastructure failure prevents the comparison, only one number remains visible. The visible number is not necessarily the accurate number, for those who understand the difference between visibility and truth. For those who notice when screens go dark at moments of maximum relevance. For those who ask not what the screen says, but what the screen cannot say when it is not there. The pattern is the signal, the darkness is the message.